Income Tax 2020, Tax Software Example, Capital Gains. Come in, relax with Income Tax 2020. Here we are in our Lacerte tax software. You don't need the Lacerte tax software in order to follow along, although I do believe they have a 30-day free trial, so it might be worth checking out if you have access to it. But we'll basically be looking at the Form 1040. We'll be jumping back and forth from the data input to the Form 1040 so we can run different scenarios quite quickly, concentrating in on capital gains on the Schedule D, the effect of those capital gains on then, of course, the Form 1040. Now, remember, as we do this, we're concentrating on the sale of stocks here. Capital gains in and of itself is a very wide category. We can have a whole course just on capital gains, but when you're doing the individual tax returns, the ones you're most likely to see are going to be capital gains for the purchase and sale of stocks, for which you will be getting a 1099, typically from the broker, that's going to give you the necessary information, which might look something like this, might look a little bit different than this, but the boxes will be standardized. Boxes will be standardized, therefore you can look up the instructions if you need help related to a form such as the 1099-B. Okay, so we're going to start off with our individual taxpayer. We have Eric Smith as a single taxpayer here. If we scroll down, we're going to start off with the $100,000 in wages. We have the standard deductions, going to be the $12,400, giving us our taxable income at the $87,600. We're mirroring that on our tax worksheet over here. $100,000 standard deduction, $12,400, $86,000 or $87,600 being our starting point. Let's take a look at the tax that is being calculated on page 2. So if we look at the tax on page 2, we're at $15,110. So that's going to be our starting point, where we have the 15,110. Was that right? Is that right? That's right. Okay, back to page 1. Now we're going to be concentrating in on the capital gains. So capital gains typically with the sale of stock, for which we're going to be having this form. So we're going to see this form within our tax preparation, whether it be our own or someone else's. This is 2021, I know, and it would be 2020, but that's going to be the basic form. So then we're going to have the line 7 here, capital gain or loss, attach Schedule D if required. So we're going to basically be attaching Schedule D. We're going to be focusing in on Schedule D. Let's go to that schedule. That's going to be the capital gains and loss schedule. You can see on the top here, we got the short-term capital gains and losses. Those are typically for the types of things, in our case, stock sales that were sold or held on to for less than a year before sold. And then we have the long-term capital gains and losses. So the general idea here, short-term capital gains and losses, basically taxed at normal, ordinary income rates. Long-term capital gains and losses, typically having a whole different set of rates that will typically be beneficial for capital gains tax rates. And then, of course, we have all this kind of confusion. Well, in the case of we have a combination of short-term gains and losses and long-term gains and losses. So we'll do a few different scenarios to kind of work some of those out. So let's go back on over here. We're going to say, let's go into the income and say that we have distributions. So I'm going to go income and we're going to go down distributions. Let me do that again. Distributions and then Schedule D. So data input screens might look different from tax software to tax software, but the basic structure will be the same. I'm going to say quantity. Now I'm imagining stocks here. So this is the information you would find from your broker information. Now note that typically you'll have like the summary information on the 1099-B, which could indicate multiple stocks that were then sold, and then you're going to have to go into the detail, which will typically be the year-end detail to break out the actual stocks that were sold. Also note that from a practical standpoint, if you're dealing with like a stock trader, someone that trades a lot of stocks, then you might have like a supplemental schedule. In other words, you might try to summarize basically all the gains in one group and all the losses in another group, and then provide the detail in a summary in another schedule that you will then give to the IRS. So you can attach a schedule. Software has abilities to do that. So that's one method you can use. If there's only a few gains or losses that are represented by this form, then you can then put in the detail. You want to go and put in the detail and look at the actual stocks that were sold and basically line up the stocks. So I'm just going to do this one at a time with imaginary stocks, just so we can see the effect on the Schedule D. But just remember, in practice, you're going to have the 1099-B and then the detail, which is going to give you the gain and loss for each individual stock, which you should put in here line by line, or group them together in terms of short-term and long-term in total. and then give the more detail that would be necessary with an attached schedule that you would attach to the tax return in some way, some shape, some form. So I'm going to say, let's say that we have 10. I'm going to say stock number 1, date acquired. I'm just going to make sure for the first one that it's over a year. So 01/01/00 and 2000 then. Date sold sometime in the current year, 2020. So I'm just going to say 06/15/20. And then the sales price, if we only sold one item, that's what would be on the 1099B for sure. You know what the sales price is. The cost or basis is a little bit more difficult to understand. But again, you probably need the more detail if there's more than one item that was sold so that you can break those items out. So we're going to say sales price. Let's say the sales price was $5,000, and I'm going to say the cost, what we purchased them for, this being the more complicated format, often provided by the broker, but not always provided because they may not have that information, in which case you're going to have to do your best bet to estimate it. So I'm going to say 4,000 here. And then you could have expenses of the sale. So if you're dealing with a sale of stocks and it costs in order to sell the stock, then you might have expenses related to them here. If it's a brokerage account, then you may not have items here, but just note that, just realize that I'm not going to include any here. This, of course, would result in a $1,000 gain. Let's just check what that would look like. If we go over to the forms here, we're going to say, all right, it's not in the short term. I'm on Schedule D. Schedule D is now highlighted in Lacert or boldened, meaning we're using that form. Scrolling down to the long term, there's the $5,000 on the proceeds. There's the cost. There's the $1,000 on the gain. That gain rolls then down forward to the net long-term capital gain or loss. That then go to part 3 on the back. So if we go then to part 3 here and scroll on down, we have combined lines 1 through 50 and enter the result. And then it says, if line 16 is a gain, enter the amount on line 16, form 1040. It is a gain. That's what we're going to do. So if I go back up to the 1040 then, now we have that $1,000 here. So there's the $1,000 that increases our income to the 101. And we have the standard deduction at the 12,004 and the 88.6. However, there's something that's a little bit hidden here, and that is the fact that this gain, because it's long-term, is most likely going to have a favorable tax rate, a lower tax rate than the normal ordinary income. So when I check it over here on our worksheet, I'm going to say, okay, there was a capital gain. I typically will add another worksheet over here with the Schedule D. I'm going to say it was a long-term. Stocks were sold 5,000 and 4,000. The formula is going to be this minus this. I'll calculate the gain, which rolls over down below, and that should roll into the first line item of the form. So now we have it included there. We're at the 101 minus the 12,004. That gets us the 88.6. The 88.6, that's what ties out here. Now we're going to depend on the tax return to do the tax calculation. If I go back to page 2, they're calculating it at the 15,260. 15,260. Let's put that here on the side, 15260. And take the difference now, this minus this. The tax increased by 150. 150, what's the tax rate then? 150 divided by 1,000 that we increased it by means they taxed it at 15%, which is a lower tax rate because if I go back on over here and say, okay, let's look at their tax summary, then they should be at an average tax rate of 17.2 and a marginal tax rate of 24. So they're taxing it at the lower rate. And that's not something we'll really see when we're doing our double check over here, because we're letting the computer do the calculation of the tax, because that's the complex point, while we verify basically the taxable income and then the payment and credit type of side of things. And so that's something you need to know so that when you talk to the clients about capital gains and tax planning and whatnot, you realize that you could have favorable rates for the capital gains. They're not being taxed at the ordinary income rates if they are long-term. Let's go back on over and say, well, what if it was short-term then? Let's say this happened on January, so they bought it in the same year that they sold it. So they've been holding on to it for less than a year. Let's see what will happen then. So we're going to say the Schedule D. Now it's up at the top in the Part 1, short-term capital gain. We still have the 1,000. Nothing's in the long-term side. Then if we then go to page 2, we still have a gain that rolls over to the 1040, just like it was before. back on over on the 1040. We're still at the taxable income of the 88.6. That hasn't changed at all. That's where we were last time. But the tax calculation, let's check out the tax calculation, is now at the 15,350. 15,350. Let's put that over here. 15,350. That means that this one, it was before the 1,000. This minus this. So the rate then is going to be this divided by 1,000. And I'm going to percentify this. That's taxed at 24% now. The ordinary income tax rates for our particular client here, not getting a benefit because now we're looking at the short term. So we can see here that if I go to the tax table, that added 1,000 would tax at the highest rate, the marginal tax rate. So of course that's going to be the benefit of the capital gains to incentivize people to invest in the stocks and bonds. So let's say we had a little both. Let's say we had, all right, well, let's say that we had long-term capital gain this time. Let's put this one back to like 2,000. So that's going to be a long-term capital gain. And let's say that this was 2,000. So let's make this 3,000. So we got a 2,000 gain. And then we had another transaction where we sold like 15 of stock 2, and this one's short term, 010120 to 091620, and this one we're going to say was, let's say 10,000 is what we sold it for, and then we bought it for, let's say 12,000. So now we have, we're breaking even. But this top one was long-term, and this bottom one is short-term. So we have a long-term gain and a short-term loss. Let's see what that does on the tax return. If I go back on over, I'm going to say, all right, Schedule D over here. Then we have up top, we've got the short-term gains, which happen to be a loss now, a loss of the 2,000. And then down here on the long-term gains and losses, we had a gain of the 2,000. If I go then to page 2, we're going to say that we net those two out and nothing's here. They net out. If I go back up to the Form 1040, we are at the 87,006. Nothing is included in the income here because we had a gain and loss that netted out, even though one was short-term and long-term. If I do the tax calculation, we're back to that 15,110. So we netted them both out, even though one was short-term and one was long-term. Now let's reverse the order. Or let's say we have a long-term capital gain of this amount, and then we have a loss that's going to be, let's say, the loss is only 1,000. So now we have a $1,000 difference. We basically have a gain, and the gain is basically the long-term capital gain was for 2,000, and then the loss was 1,000, netting out to 1,000 gain. And so if I go back on over and say, all right, what does that look like? So now we've got the $1,000 loss. We had a short-term loss, and then we had a long-term gain at the 2,000. If we go then to page 2, then we have the 1,000 on page 2 that's going to roll over or roll into the 1040. So then we have the 1040 here. There's the 1,000. So we're back to the 101 again because they netted out. And then we have the 88.6. If we take a look at page 2, now we're at the 15,260 on the tax calculation. The 15,260 here. So again, that netted out, and they basically then we calculated the taxable gain at the favorable rate of 15%, netting out the capital gains and the short-term capital gains to the long-term capital gains. What if we do it the other way? We're going to say, all right, well, what if this top one was short-term? So I'll make this 2020, and I'll make this one 2000. So now we've got, if we take a look at that, same 1,000, but now I'm going to go back on over and say, all right, let's check that out. Schedule D. We're going to say, okay, now the short-term capital gain, the short-term amount was 2,000 gain, and then the long-term was a loss. So now we have if we net them both out, we're left with a short-term gain of 1,000. So we're going to net them out. We're back to the 1,000. If I go back to the 1040, then again, we're at the 1,000 gain, 88.6, same on the first page. The tax now, however, calculated at the 15,350. the 15,350 here, which means they netted out the short term and long term. Now we netted out with the short term of 1,000 over, which they taxed at. We taxed at 24%, the higher, more marginal ordinary income rates. So you can see these combinations get a little bit confusing, and they can kind of affect your tax planning strategies as well. Now, what if we had a loss? Let's say we had a loss. Let's just delete the second line. I'm just going to delete this and say, let's just go long-term loss. Let's say 061500, and say we have a loss of let's say make of 5,000. Let's make this 10,000. We got a loss of 5,000. So if I go back to home and I go to the Schedule D, now we have long-term loss down here of 95,000. That's too much. I didn't want 95. That looks funny. That's too much. I'm gonna go. That makes me sad if I lost that much. So I'm gonna go back on over 5,000. All right, I can deal with that. Okay, so 5,000, and then so that means we've got the 5,000 up here as a loss, and note down here we're then going to be capped to the loss. If line 16 is less than blah blah, the loss on line 16 3,000, or if married filing separately 1,500. So we're going to take that 3,000 of the loss, in other words, of 5,000. We're only going to get 3,000. If I go back to the Form 1040. Now we have a 3,000 loss of the 5,000. Now, again, the IRS is skeptical of losses. Why? Because not only are you not paying taxes on it, you're lowering other income. So you're lowering your W-2 income. So now income is going down to 97. That's why they limit it. So they're going to limit it to 3,000 per year, and then you still get a benefit from it, possibly if it rolls over into the following year. So if I was to do that on my worksheet, I'd say, okay, worksheet. Let's say that we had, what did we say? We had 5,000, and then this was 10,000. So now we have a loss of 5,000, but this 5,000 is going to be limited to basically 3,000. So I'm going to add a line called limit slash carryovers, limit slash carryover, and that's going to be for 2,000. So that means, you know, there was a $5,000 loss. It's going to be limited by 2,000, and that 2,000 could then be carried over possibly to future periods, either being taken in the future against other capital gains, or possibly 3,000 of it, in this case would be all of it, taken in the following year. So then we're going to say, okay, that if I pull that over to page 1, then we then have the amount pulled forward that would be included, the 97 standard deduction. That gets us to the 84.6. So that would bring us to the 84.6. And so that looks correct. And then, of course, the calculation on that will typically be the ordinary income rates. So notice when you take the loss of 3,000, you will typically get a benefit. In other words, they're not gonna give you different rates for the loss you're taking. So you get, on capital gains, you get a beneficial rate. On the losses for the 3,000, you actually get the benefit of taking the loss generally at the ordinary income rates, which in this case would be at the marginal rate of the 22% generally. So in other words, if I went back to the Form 1040 and looked at page 2, the Form 1040 page 2, the calculation is now 14,408. So we're at 14,408. Let's just put that somewhere else. 14408 here, and that then, the difference between what it was before, we took the loss of 3,000 now, this minus this is 702 difference, and the rate then of this divided by 3,000, percentifying it, is about 23%, which is the marginal rate. So we're getting a benefit this time, reducing the tax by about, you know, the marginal rate, it looks. Okay, so let's run another scenario. Let's go back on over, and let's say there was a carryover from the prior year. So let's say, okay, now we've got, let's make this back to 10,000. Let's make this 2,000. So now we have a gain. So if I go back on over to the Schedule D, we're going to say, okay, now we got a long-term gain here. And let's say there was a carryover from the prior period. So I'm going to jump to the carryover data input. And we're going to say that there was a loss that was carried over from the prior period. And let's say now let's say the loss was 7,000 and it's long term that we're going to be carrying over. So I'm sorry, we're going to say 7,000, no negative number. And then I'm going to bring that back over. I'm going to say, okay. And so now if I say we had the 8,000 gain minus the 7,000 loss. So notice, even though I'm limited to 3,000 loss, if I had the gain to net it out against, then we'd be able to take that loss. And so now we got that nets out to 1,000 now. What if the loss was greater? What if the loss was like 15,000? And then I'm going to go back on over and say, all right, well, what if the loss is 15,000? Now I had 8,000, 15,000. Now I have a 7,000 net loss. If I go then to page 2, that's going to net out at the loss of 7,000 after the carryover, bringing us to a 3,000 again, which is going to roll over to the 1040. It's going to limit us to, again, that 3,000. The difference then possibly could be carried over to the future. Now note, this carryover can be confusing. There could be nuances to a carryover with the capital gains. So if you have capital gains carryovers and this is a new client, well, if it's a continuing client, just note that this will be populated for you generally if you pro forma over the tax return from the prior year correctly, and you just have to be aware of it when populating your information into your Excel worksheet and whatnot and just double checking your data. However, if it's a new client and it's a complex client that has a lot of stock transactions, especially if it has loss carryovers, it might be beneficial for you to then input the data into the 2019 tax return, make sure it ties out to what you have on the paper tax return that's provided for you, getting that from the client, and then pro forma it in forward so that you make sure that you get these carryovers done correctly. So again, the more complex the return is, the more links to the prior year, include the things like itemized deductions, like capital loss carryovers, passive income, and that kind of thing. The more, if it's a new client, you're going to want to enter the data possibly into the prior year tax return, get a feel for the tax return itself by doing that data input, and be able to take advantage of the pro forma information so that the carryover information, any carryover information will then populate properly in the current year, and your job then is to double check and verify that it has populated correctly by double checking with basically the Excel worksheet.